Welcome to the Roadmap to Currency Riches instrument module on Spot FX, one of the 5 instruments for investment that are covered in this course. The spot foreign exchange, also known as Forex or FX, market trades about 3 to 5 trillion per day, according to the Bank for International Settlements, which periodically surveys the market. The chief players in the FX market are banks, brokers, hedge funds, and other fund managers who trade FX for their own accounts in blocks of 5 to 10 million. And the largest trade in yards, which are billions of units of currency. A trade of 1 to 3 million would be considered small, and trades of 50 million are routinely seen on the electronic brokerage system, or EBS, which is the central global trading platform today. From the floating of the dollar in 1974 until the internet took root in 1998, the FX trading world was rigidly divided between those who traded in the professional spot market and those who traded in the futures market. Each group had its own culture, convention, and rules. But the biggest difference between the two groups boiled down to transaction size combined with credit worthiness. If you were a multinational corporation with a line of credit at a trading bank, you could sell 50 million Japanese yen in the spot or forward market for dollars. If you were a small importer, 250,000 of Italian baby clothes as an example, chances are you didn't have the financial standing to get a bank line of credit to buy euros to pay for your purchases. So you used the futures market. If you were an individual speculator, you had to be a multimillionaire to get a bank line of credit to trade in FX, while everybody else had to open an account at a futures brokerage house. The advent of the internet and high-speed electronic transaction processing changed everything. Spot brokerages for retail markets sprang up like mushrooms, advertising commission-free trading that puts the retail trader in the same league as the bank professionals, hedge funds, and multinational corporations and the multimillionaires. Let me warn you though, the spot market is one of the most risky of all the instruments that we have been discussing in this training. The only instrument that is more risky is futures. Let me introduce you to our expert for this module, Sean Hyman. He has many years of experience and has been the lead throughout this program. Welcome, Sean.
Thanks, Bentley. Yeah, I want to begin by sharing with you some amazing figures. These are official government numbers on the actual cash profits that U.S. banks are generating exclusively from their currency trading. Then I want to show you how the individual investor has the opportunity to replicate these results on a smaller scale, of course.
Okay, great.
In 1995 and 1996, the banks earned about $2.5 billion per year in Forex. And in 1997, they earned $3.9 billion.
Wow.
From 1998 to 2003, they earned between $4.5 billion and $5.5 billion a year. And in 2004 and 2005, they earned about $6 billion a year.
So it keeps going up.
It's amazing.
Yep.
Even during the worst of the recession, even with the credit crisis, the oil crisis, and the housing bust, they earned between $7 and $8 billion per year. It's amazing.
Yeah.
Even for small investors, these big Forex profits have been flowing, regardless of what has happened really in the economy, the stock market, the interest rate market, or any other market for that matter. And it's no mystery that they don't have magic secret formulas. They don't know more fundamental economics or even better charts or use more technical tools than other investors. They crank out the profits simply by applying the very best rules of trading available with discipline, and they do it very carefully.
That's because I guess a lot of the internet tools and services are all available to everyone nowadays. So for them, it's the same as it is for an individual investor.
Yeah, absolutely. I mean, it's a fact, and it's so simple that sometimes people don't believe it. I mean, it's the whole concept of trading rules and how you apply them, really. Mm-hmm. These traders connect events to what trade they should take next, and then they quickly take profits or get out if they're wrong. They make the trade that's going to be short-term based on the announcement of the big macro news events. The breadth, the depth, the liquidity of the market are truly impressive. I mean, it's been estimated that the world's most active exchange rates, like euro dollar and dollar yen, can change up to 18,000 times during a single day.
Wow.
Somewhere on the planet, financial centers are open for business, and banks and other institutions are trading the dollar and other currencies every hour, every day and every night, aside from possible minor gaps on weekends.
Okay.
In financial centers around the world, business hours overlap. As some centers close, others open and begin to trade. The foreign exchange market follows the sun really around the earth.
Okay.
Each business day arrives first in the Asia Pacific financial centers.
Okay.
First Wellington, New Zealand, then Sydney, Australia, followed by Tokyo, Hong Kong, and then Singapore. A few hours later, while markets remain active in those Asian centers, trading begins in Bahrain and elsewhere in the Middle East. Later still, when it's late in the business day, Tokyo markets and markets in Europe open for business. Subsequently, when it is early afternoon in Europe, trading in New York and other centers starts.
Okay.
Finally, completing the circle, when it's in the middle or late afternoon in the United States, 5 p.m. Eastern Time is when the next international business day starts. The next day has arrived in Asia Pacific area all over again. So the first markets there have opened, and the process begins again.
Okay, that makes sense. Can we go over some of the terms in the spot market? For instance, what does it mean when you say spot or bid and ask?
Yeah, a spot transaction is a straightforward or outright exchange of one currency for another. The spot rate is the current market price or cash rate.
Okay.
Spot transactions do not require immediate settlement or payment on the spot. By convention, the settlement date or value date is the second business day after the deal rate on which transaction is made by the two parties.
So you have a little bit of time, but that's when you're going to be settling up a couple days later.
Yeah.
Okay.
And of course, next we got bid ask.
All right.
In the foreign exchange market, and essentially in all markets, there's a buying price and a selling price. It's important to perceive these prices as a reflection of market condition. A market maker, someone that quotes both a buy quote and a sell quote in the financial instrument, is expected to quote simultaneously for his customers on both a price at which he's willing to buy, which is the bid, and the price at which he's willing to sell, which is the ask. Standard amounts of any currency for which he is making a market.
Okay.
And generally speaking, the difference between the bid and the ask rates reflects the level of liquidity on a certain instrument.
All right.
So on a normal trading day, the major currency pairs, Euro dollar, dollar yen, dollar Swiss, dollar CAD, the Aussie dollar and pound dollar are traded by a multitude of market participants every few seconds. High liquidity means there's always a seller for your buy and a buyer for your seller to act on these actual prices.
Okay. In another module, we talked about base currency and counter currency. Can you elaborate on these terms for us?
Yes. Every foreign exchange transaction involves two currencies.
Right.
It's important to keep straight which is the base currency and which is the counter currency.
Okay.
In trading communications, the base currency is always stated first. For example, quotation for dollar yen means that the U.S. dollar is the base currency. It's the one on the left, and the yen is the counter currency or the one listed in the pairing on the right. And in the case of the pound dollar, usually called cable, the British pound is the base currency in that instance, and the U.S. dollar is the counter currency. When a pair moves up, the base currency is appreciating against the counter currency. For example, if the pair euro dollar moves higher, that means that a unit of euro buys more units of dollars, and when the pair moves down, the counter currency is appreciating against the base currency.
Okay. Well, Sean, how do you actually buy a currency pair?
Yeah, quotes are always done in terms of the base currency.
Okay.
So, traders think in terms of how much it costs to buy or sell the base currency. When an ask quote is 150.95 is given, for instance, it means that a trader can buy euro against USD at 150.95. If the trader is buying euro USD for a million units at the rate, he or she would have to pay in USD terms $1,509,500 in exchange for his million euros. Of course, traders are not actually interested in exchanging a large amount of different currencies, and their main focus is going to be buying at a low rate and selling at a higher one, just like you would in stocks or anything else.
Great. Now what about increments you can buy in? I believe these are called pips. How does all that work?
Yeah, for most currencies, bid and offer quotes are carried down to the fourth decimal place.
Okay.
Yeah. This represents 1/100th of 1% or 1/10,000th of the counter currency unit, usually called a pip. And however, for a few currency units, they're relatively small. in absolute value, such as like the Japanese yen, for instance. Quotes may be carried down to only 2 decimal places, and a pip is then a hundredth of in terms of currency unit. Okay. In foreign exchange, though, a pip is the smallest amount by which a price can fluctuate in the market. So that's really the core thing to keep in mind there.
Okay. So up to this point, we've been talking about U.S. dollar versus other currencies. What about currency crosses, such as, I want to buy euro to yen?
Yeah, good question. Euro cross rates are currency pairs that involve the euro versus another currency. So examples of, euro crosses are euro yen, euro Swiss, and euro pound. And, currency pairs that basically don't involve the dollar are called cross rates. So you're taking the dollar out of the equation. Okay. Examples of cross rates are, pound yen, Swiss yen. Of course, hundreds of cross rates exist and involve exotic pairs, but they are often, plagued by low liquidity.
Yeah. It sounds pretty straightforward, although I know it's not. It's actually much more risky, but the rewards can be great. Sean, can you share with us what you think are the many advantages to trading spot foreign exchange as opposed to trading stocks or futures?
Yeah. Sure, let's start with, bid-ask spread rates, for instance. Okay. And really, let's back up and say, what is the definition of a spread rate? The spread is the difference between the bid and the ask price, or the sell and the buy quote. Mm-hmm. And so the wider that is, the more your fee is that you pay to make that transaction, and the narrower that is, the less your transaction costs to make that same transaction to buy euro dollar, for instance.
That's important.
Yeah. So spread rates, have tightened dramatically in the last several years. I mean, most online forex brokers, used to offer spreads of like 5 pips or even larger, and it's more like 2 pips these days. Sometimes like even 1.5 pips at times on euro dollar, which is really the most widely traded liquid currency pair in the entire world.
So that actually means it's costing us less to buy them now than it used to.
Right.
Okay,
exactly.
That's great. So, Sean, that's great. So tell me a little bit about margin requirements.
Yeah, margin requirements, usually a foreign exchange trading with like 1% margin is available, for instance. Okay. So in layman's terms, this means a trader can control a position with a value of, $1 million and, with a mere $10,000 in his account. Or even, there's, it can be scaled down to, tenfold typically, in other words, even if you're using smaller units. By comparison, futures margins are not only constantly changing, but are often quite sizable. Stocks are generally traded on a non-margin basis, and when they are, it can even be as restrictive as 50% or so is the margin that you usually
so margin is more common and more available, it seems, in the spot market in currencies.
Yes.
Okay, great. What else can you tell me about the foreign exchange market? How about how it's open, the hours it's open, and what happens?
Yeah, basically it's a 24-hour market. Right. Foreign exchange market trading occurs over a 24-hour period, picking up in Asia, and Sunday evenings, and then coming around to the end of the United States on Friday evenings, and so it really goes 24 hours a day, Sunday through Friday. Right. Although electronic communication networks, or ECNs, exist for stock markets and futures markets like Globex that supply after-hours trading, liquidity is really often very, very low, very thin, and prices offered can often be very uncompetitive.
Yep. It's funny. I could see myself getting up in the middle of the night and getting into this and really trying to make a trade. It sounds like I can do that anytime I want. Also, I've been told by many of friends that have traded in the market is not to go to sleep with a trade open. You could wake up with a margin call or something. So there's all kinds of interesting things about the 7x24 trading in this market, but it is an opportunity to look at that. Is there a trading window that you see most activity in that 24-hour period? You see that often?
Yeah, a lot of people will trade things like the London Session Open and those hours, and then the U.S. hours, but it's not really restrictive like in the futures market. To go to my next point, you really have certain parameters and limits. Like there's what's called a limit up that you can hit, or a limit down in the futures markets, and that basically just means that it's the maximum that it's allowed for that futures contract to go up during that day or down during that day, and you really don't have that limitation, in the spot forex market. Okay. So there are certain constraints there that limit the number and type of transactions a trader can have in futures. That can make it under certain price conditions a little bit difficult. But when the price of a certain currency rises or falls beyond a certain predetermined daily level, traders are restricted from initiating new positions and are limited only to liquidating existing positions and if they so desire, basically. This mechanism is meant to be control daily price volatility in futures, but in effect, since the futures currency market follows the spot market anyway, the following day the futures market may undergo what is called a gap, or in other words, the futures price will readjust to the spot price the next day. Spot FX trades, basically in the over-the-counter market, where no such trading constraints really exist, permitting the trader to truly implement his trading strategy to the fullest extent.
Yep.
Since a trader can protect his position from large, unexpected price movements with stop-loss orders, and the high volatility in the spot market really can be fully controlled.
Yeah, and we talked quite a bit about stop-loss in the introduction modules and what that offers us. So let me just kind of summarize quickly here: is that you really have no limits in the spot. You can trade 7 by 24. You can get margin to advance your position. Your smallest increment is in pips, so you can actually make very small trades, very large trades. And there's really, from what I understand, there's really no minimum amount you have to trade. You can trade in all kinds of sizes, and you have all of the same kind of opportunity for research that every large corporation has. To be able to make yourself prepared. You have much opportunity in this as you would in any other. Is there any other advantages we might want to look at?
Yeah, one final advantage, is that you can sell before you buy. In other words,
sell before you buy.
Yeah, some people call selling short.
Okay.
Equity brokers often make you. It's very restrictive on how you're able to do short selling.
Okay.
The margin requirements are fairly atrocious. This means that a customer really does not possess the liquidity to be able to sell a stock before he buys it really very easily. Margin-wise, a trader has exactly the same capacity when initiating a selling or buying position in the spot market. You can do either one just as equally as easy. Because in the spot market, remember, you're always, selling one currency and automatically buying another anyway.
In other modules, we've talked about currency trading as a way to invest, especially for CDs, ETFs, and even options. But with spot, it sounds more like we are speculating. Can you share with us the difference between the two?
Yeah, it is really very important, that the individual wanting to trade foreign exchange be aware that the very marked difference between speculation and investment. I mean, foreign exchange trading is by nature a speculative occupation. Foreign exchange markets are among the most volatile markets in the world. When trading on a margin basis, they effectively become the most volatile in the world too. Day trading in foreign exchange can be extremely profitable, and high-risk profile traders can generate huge percentage returns even overnight. Day trading is, however, a mentally and psychologically challenging activity and is by no means meant for everyone. Day trading is essentially speculation, and day traders essentially only do that. However, most people who trade foreign exchange are not professional day traders. Often, the contractors of foreign exchange brokerage services are professionals in some capacity or another. These people do not day trade, but take the occasional position from time to time. There's also speculation, and should not be confused with making an investment. The conclusion here is that the nature of spot foreign exchange trading does not lend itself as much to investment as it does to speculation and hedging. It is possible, in a sense, to make an investment in foreign exchange over a long-term period, but this necessitates a large account value and low levering, basically.
Or using one of the other instruments versus doing something that is so volatile.
Exactly.
Okay, this is fascinating. Over the years, I've been studying currencies. I have noticed that there is a lot of politics and national pride in currency. I've learned lessons to never make fun of a country's currency, as that has caught me, and it could be an insult. But we don't actually, in the United States, we don't see other currencies as our typical investment, as we've talked about, currencies as a way to diversify. Things I did learn, there are some semantics or different ways of saying things, or even terms for currencies, such as the loonie for the Canadian dollar. In fact, the first time I heard that, it's when I made the joke and I learned this lesson. And they have a different reason for it, or the kiwi for New Zealand. How did this all come about?
Yeah, back in the midst of time, all foreign exchange traders used the American Quotation Convention, which basically says how many units of foreign currency $1 will buy. And
Okay.
the Canadian dollar or loonie, for example, is worth 97.20. As this example, meaning one Canadian dollar is worth 0.9720 or
Right,
or
right,
97.20. Using the American Quotation Convention puts the U.S. dollar at the center of the foreign exchange universe.
Okay.
Everything was priced in U.S. dollars. We still do this basically for all commodities, including oil, gold, silver, copper, soybeans, corn, wheat, coffee, cocoa, etc. I mean, you name it. The list goes on. Moreover, every futures trading exchange around the world prices commodities in terms of units per dollar, whether bushels, ounces, or barrels, or what have you. So yes, you can trade oil futures in London, quoted in British pounds, but the volume, is in the dollar-denominated contract.
Okay.
Back in the old days, you could look at the spot price for the Canadian dollar at 77.20, and the futures price for delivery date in the 3 months at 77.05, and instantly know that the 15 cents difference was due to the Canadian dollar delivering 15 cents worth of extra interest rate earnings, beyond the interest rate earnings to be earned on the U.S. dollars over the 3-month period. So easy, But then in the 1970s, European FX dealers, took umbrage, basically at being priced in dollars. They didn't like that. And in those pre-Euro days, we still had Deutschmarks and French francs and Italian lira and Belgian francs and just all these, etc.
Yeah.
When the Deutschmark was quoted in dollar terms as at say 40 cents, the quotation convention puts the dollar at the center of the price quotation. Think of it as Deutschmark per dollar. But the German currency was on a par with any other commodity, like the lowly soybean. Quoted in bushels per dollar.
Yeah.
This was vaguely, belittling or insulting, as you would have found out.
Yeah, sure, makes sense.
So, 33 years after the end of World War II, Germany was a powerhouse of economic success. The German treasury was stuffed with dollars to spend. Germans wanted to know the price of things in their own currency, including the price of the commodity named the dollar, which was and remains the medium of exchange for all the other commodities. German traders preferred to pose the question in terms of how many dollars can one Deutschmark buy instead of how many Deutschmarks can $1 buy. Think of it as a dollar per Deutschmark or dollar mark. From the German perspective, this puts the German currency at the center of the price quote.
And with national pride, I can see how that could develop. Yeah.
Absolutely. And the European currency traders prevailed. I mean, in 1978, the International Forex Association agreed that European currencies would be quoted in the European Quotation Convention, or the number of units in the foreign currency that one Deutschmark can command. Thus, instead of the Deutschmark being worth 40 cents, a small number of pennies really, each dollar became worth Deutschmark 2.50, and so you'll have to decide for yourself whether dollar mark at 2.50 confers more dignity, stature, and prestige than Deutschmark dollar at 40 cents.
Why does this matter?
Yeah, a major and disagreeable side effect is that now you cannot easily compare the European Quotation Convention, spot price with the American quotation, the futures price.
I've run into that. That is challenging.
So to do that now, first you have to convert the spot price back to American terms by dividing it into one and then adding or subtracting the interest rate differential between the two countries. Whereas before you knew that the differential instantly. You knew this simply by subtraction, and now you had to go through the complex rigmarole just to figure out if there was an arbitrage opportunity between the two markets.
Okay.
But now a quirk of fate appears. As it happened, except for the British pound, every other major traded currency was priced at less than the dollar, or less than $1.
Right.
Involving that implying really that they were somehow secondary. The yen, for example, started in the 1970s at over 400 yen per dollar, and by 1978 had appreciated only to about 200 per dollar. In other words, at 200 yen per dollar, each yen is worth only about 0.005 or half of a U.S. penny. So ironically, it came to be perceived that the second name of any currency pair is the secondary or weaker currency, so that when you quote the dollar Deutschmark, you are implicitly putting the Deutschmark in position of second class.
Yeah, okay, I can see that. And what's interesting, as you said, is that it's improved in value. It actually went down. So, oh boy, is this confusing.
Yeah.
All right.
So, and perhaps for this reason, or some of the reason known only to the founders of the European Monetary Union, when the euro came into existence on January 2nd, 1999, they chose the American Quotation Convention. Now, the name of the euro comes first in the Euro-Dollar Quotation Convention, and never mind that, this bias caused untold misery for millions of traders and brokers alike who confused the euro-dollar currency quote with the euro-dollar interest rate quote. It's a big confusion there. And, but in fact, we still don't have a universally accepted way of distinguishing between the two. I mean, traders have to specify euro currency when they place orders, unless they get saddled with a euro-dollar interest rate contract they didn't want or don't even understand, for that matter.
Okay. Well, that explains a lot, and I'm sure there's a lot more of that you could share, but we're running out of time. Is there any golden nugget that you'd like to share with our viewers about, their trading and their early trading in spot markets?
Yeah, absolutely. When you're first new to this market, absolutely go ahead and set up a demo account. Some people call these virtual accounts or demo accounts. Set that up so that you can learn how to place a buy order, a sell short order, get your stops and limits in, and learn all those little market mechanics before messing with live money in an account. However, the biggest dynamic really that is untouched in a demo account that comes into fruition is when you switch from being a demo user to a live account user. Even if you start with a micro account, even if it's as small as $500, doesn't matter. You all of a sudden become emotionally and psychologically engaged in that trade now. And that is a different dynamic than what you would have if you were trading the smallest or largest amount in a demo trade. You could place a demo trade, not even have a stop, go to bed and sleep like a baby.
And so who cares? You can't lose anything.
Right.
It's not real.
You could clean out that demo account and just start a new one tomorrow.
Start a new one the next day.
Exactly. But you're not going to want to do that with your live money, obviously. And if something happened like that, continually refunding the account. So you're definitely a little bit more married to the trade emotionally, and you got a lot more skin in the game there. So that's really where you're going to find out what you're really truly made out of. Even if it's on that smallest of scale, start with that little micro account. Start with just a handful of $100, $500, something like that, and get started there. Trade one lot trades at a time, and there you will deal with the emotional side of trading. You'll also really find out a little bit more about yourself from a trading perspective, and find out whether you're a short-term trader or a long-term trader or a medium-term type swing type trader. And so I think you'll really position yourself really quite quickly once you find out what type of trading style that you're acclimated to, according to your personality and risk temperament.
And that's interesting. And the spot market is truly the real trade, one currency against the other. And so I will learn a little bit about myself. But, you're so right. I could care less if I lose the money that was given to me that's fake. It's like printing my own money. But when I have my own money in it and I have emotion attached to it, I'm going to watch it a lot more carefully, and I'm probably going to learn a lot more in that period. So that's a terrific golden nugget, Sean. I'm going to put that one away, and I suggest that our viewers write that one down in their book, and remember that Sean's strategy for getting started, that's obviously before you start investing your risk capital in any big way. Thank you, Sean, for your insights and leadership in the spot market. You obviously have a lot of experience here, and I know that I have learned a heck of a lot, so really do appreciate that. Although traditionally and historically, spot currency trading is inherently governmental, commercial, and institutional, the advent of the internet has opened up the spot market to private investors like ourselves. Forex trading holds several attractions for the private investor. 24-hour a day, 6 days a week. A vast liquid market, making it easy to exchange most currencies. The ability to profit in rising or falling markets. Recognized instruments for controlling risk. Leverage trading with low margin requirements. And zero dealing commissions. It is a market that, when you are ready, you can make a lot of money with. It takes dedication and very close controls, and don't forget the stops. It is a market that you don't want to go to sleep and forget about because, like I said earlier, you could wake up to a margin call, which is not something you want. For those who can, it is a market with endless profit possibilities. But as with any instrument, there are risks. Spot has big risks, so only use funds that you feel that you can risk. This concludes our module on Spot FX. I hope you have enjoyed and learned a lot. Look forward to seeing you in future modules.